happy to have Craig Vodnik back to talk to us and give his flavor of expertise around angel investing. I'll let Craig do more of an introduction about himself, but as many of you are aware, we do have or may be aware, some of you may not be, that we have a very robust entrepreneur in residence program by which all of you are welcome to ask for time with our experts. That include the lights, and actually a few of them are in this room. I see Jed and Alan Singleton, who's actually out in the atrium, and Craig is also one of those people. So feel free to, if you want more information about that, I'm happy to, but basically all you have to do is fill out a form on our website. So
thanks, Laura. Yeah, the EIR program I think is a fantastic opportunity for anybody who's part of Enterprise Works to interact with us and get some expertise in a variety of different ways. Today I want to talk about angel investing, and I have a relatively short presentation because I think that it's really important to sort of talk about the issues that you want, and I didn't want to just talk for 45 minutes about angel investing in general, but really get to some of the questions that are on your mind. That's going to help me customize this for the next time that we do it. So just a little bit of background about me. I'm a NPRE, or actually nuclear engineering graduate here from 1992. As I said last night at the engineering entrepreneurship class, I'm not using it anymore, unfortunately, but it was a means to an end, and I won't give you the full color of all the things I said last night about my transition into entrepreneurship, but I just still think that what's going on campus now is amazing compared to the opportunities for entrepreneurship are amazing compared to what was available and how people thought about it when I was going through school. So the business that I started is called Cleverbridge. It's a global subscription billing platform. We've been around for 13 years. We provide billing services for software and businesses that sell online services. So if you think about a desktop product, a desktop software product, a security product, maybe PDF software, something like that, or an online service. You could think about like Netflix or Dropbox, where people are subscribing to a product. We do this on a global basis. Myself and my partner started the business 13 years ago, and we do this on a global basis in every country in the world, from 6 offices with 300 employees and 60 million in revenue, and we're bootstrapped. So we basically put our own money in at the beginning in order to get the thing off the ground. We came into the business of e-commerce because we knew the business. We worked in e-commerce together for about 2 years, and so we understood the market and the issues that were there, and the challenges and the opportunities, such that when the company we worked for was acquired, we said we want to go off and do this ourselves. So that's just a brief sort of story on how we got into it, and we were fortunate because we were able to skip past the process of figuring out our product. In a way, we knew exactly what the market was. We knew the product market fit. So we had our e-commerce plan. We said we want to do some things better that were limited in the previous company. And so that's how we got to market very quickly. Most of you will not be in that situation. And I'm going to get to angel investing in a few minutes, but I think it really starts here with the Lean Canvas. And I know that there's been a lot of discussion more recently in some of the entrepreneurship classes and such about Lean Canvases. And I can tell you that we at Cleverbridge actually use these now. It's a great way, now that I understand them, it's really a great way of organizing your thoughts about your product and your business. Because most of the conversations I have as an angel investor are, especially when it's with companies that are at the earliest stages, it's always about the product. And the product is very important. The product is generally highlighted here in I guess it just bounces off the ceiling, but number 4, the solution. And it's really important to know that and understand when you're thinking about your business, the solution is really, and these are not my words, but the solution is the fourth most important thing. And this is something I think people don't get for a while. The solution is the fourth most important thing because it doesn't matter if you don't understand what the problem is you're trying to solve. It doesn't matter if you don't know who you're trying to sell to or who you're trying to solve the problem for. And then what is the unique value proposition that you offer? Once you understand those three other things, then you can get to the solution. And many entrepreneurs, and this is now sort of the angel side talking of having seen a lot of people, many entrepreneurs fall in love with their solution, meaning the technology or the thing that they're building, and don't really have a business for it. And there isn't a business for it because they love that thing that they're building, but they can't really clearly explain what the problem is they're solving, who they're solving it for, and why anyone should buy from them. So I'm purposely talking about this lean canvas right now and hammering on this point because I just had several conversations earlier today with companies and people who are building companies here at Research Park who it's clear to me this is a very typical way of a first-time entrepreneur to think about it. Okay, I've got this really cool idea, I've got this cool product, I want to build, this thing. It's like, that's great, it is a cool idea, it's a cool product, but how does that turn into a business? Why do people care? What is the problem you're solving? Because those are the questions that the angels are going to ask you. Any questions on that before I move on? We can always come back to this, but it's
in fact, that is the crux of a lot of tension, I would say. Because if you don't have a product that works, it doesn't matter what the problem is because you can't solve it. It doesn't matter who the customers may be because you can't serve them. And it doesn't matter what value you might have because there is no value of the product that fails to function. So would it be another way to say the same thing? That if you are fundamentally interested in design and engineering, that the solution looks like the hardest thing to do. If you're interested in sales, finding a customer is the hardest thing to do. If you're interested in making a business, finding a sustainable model for cash flow is the hardest thing, of which the solution is. So that in fact, it's not that one is more important than the other, it's that for those who are going to be investors, this is the way they see the world.
Yes, to a certain extent, a lot of that. I wouldn't say that one is more important than the other. It's just the order. The numbers here are the order that you should fill this document out. Right? That's what the numbers here are for. So yeah, let me be clear about that. That's the recommended order. I would switch 1 and 2, but I think that basically that's what that's for. But what I often see is that people who come to ask for funding have focused so much on number 4, the solution, that they don't really have, they've missed the mark. Because ultimately, the solution matters if you can find product market fit, right? So you miss product market fit, or you spend a lot of extra time trying to get to product market fit if you don't think about number 1, number 2, number 3 as part of the first 4 things.
I just wanted to ask you, you made a remark about the discussions in entrepreneur circles. Is Lean Canvas still the way to get to track the business model? Still, this has been developed quite a decade, I would say, or maybe even more.
It doesn't matter which tool you use. It's just curious. It's just curious. It's what I use right now, and it works great. I mean, if there's somebody, if there's business model canvas, there's some other ones out there. They're all kind of more or less the same. They get to the same point.
This is not a business model, per se.
Right.
This is a
Correct.
pathway, so
Correct.
don't confuse the two.
Yes. It's the business model is kind of contained herein, right? With the cost structure, the revenue streams, the channel, how you're going to get to market. Yes, I know that I have trouble with this with my colleagues in Germany because They call it a business model, and it's not a business model.
No, if there are, what I meant is if there are other constructs being described by the that's all.
Yeah.
You know, the general discussion.
Yeah, these are the important things that matter.
All right, sorry.
So is that okay so far? Any questions on that before we move on? Jed, anything to add? You're the engineering entrepreneurship expert here.
No, I think this is great. I think I like the idea of being, this is the first time I've seen this lean canvas actually. And I like the idea that starting with the problem before you get to the customer segment value proposition. Because when we use the business model canvas, that's exactly what you do, right? And I like how this lays it out just clearly, spot on.
And this is not easy to fill out. It looks easy.
Yeah.
The first time you fill it out, you should only spend an hour on it.
Yeah.
But, and I've been telling people, so Laura, you might see some requests coming in for some help from people to fill these out, because it's not easy when you really start to get to it, because you end up with multiple canvases, all kinds of stuff, because you have different client segments, you might have different solutions for different segments, so we're not going to dwell on that today. That could be another session. But again, the point here is it's not just the solution that an angel cares about. So this is a great book if you're looking for funding. This is a great book to help you understand how angel investors think. Because if you don't understand how angel investors think, and really kind of any investor, but this is specifically focusing on angel investors, you will miss the mark most likely in what you present, how you present, the things you present. So if you're interested, this is a great book. It's 300 pages, relatively easy. I'm going to go through the bullet points here really quick. An angel investing book. This is another one by the same author, which I have not read, but I suspect is going to be pretty good. But I know the angel investing book is very good. I've read it. So evaluating entrepreneurs. So this we'll talk about a little bit, and I've got a sheet here that I'll be talking about. But how do angel investors evaluate you as an entrepreneur? That's a big part of their decision of whether they invest or not. Pitching for the portfolio. So angel investors, based on this theory of a portfolio theory, is an angel investor doesn't just say, hey, you've got a great idea, I'm going to invest all my money in you and hope that this turns out to be good. Because angel investors are so great at picking the winners, the ones that are going to become successful companies. Angel investors are no better at it than basically anybody else, because if they were good at it or great at it, they would not pick losers, right? You know what I mean? The math and analysis suggests very convincingly in this book that nobody can beat the market, and so the better play is to place a bunch of bets around the table. It's basically the concept of portfolio theory. So investors will also look at you, not just for the product you have, but sometimes to fill out their own portfolio, or look at you as one component of their portfolio of many bets.
When you talk about, I mean, clearly the rate is variable. What do you guys, at your fund, what do you sort of target? What do you hope to get? What's your sort of your nominal and your aspirational hit rate of success versus failure?
To be honest, we don't look at it that way. We look at it as rate of return on the total amount of money invested. So IRR,
Internal rate of return.
Internal rate of return. And angels are probably the highest percentage. They're looking for 25% rate of return.
Across your whole portfolio.
Across all investments. So they're assuming 50% actually will go to zero.
Well, that was my question. So you hope to have at least a 50% success, whatever success means.
Yeah.
50% of greater than zero return.
Yes. Yeah, and in this book, they exactly give you the math for it, or they give the angel investors the math, which helps you understand. 50% they expect to go to zero. 20%, I think, return some capital, meaning less than was put in. I think that there's another 15% that's above that how much was put in, and then there's like 10% or 5% return most of the investment across all investments. So that's the way the portfolio theory works, and it's
No, it makes sense. I mean,
yeah. due diligence, so angel investing and what angel investors should do from a due diligence perspective to understand what it is that to give the angel investor the best chance of identifying holes in the potential investment and either trying to address those holes or choosing not to invest. So the due diligence process and the list of topics is also in this book. It's quite extensive. I have not seen any angel investment that I've done or that Hyde Park Angels does that's gone through that whole list, because it's a massive list. Valuation and expectations. This is a really good chapter in the book because it talks about how angel investors should be looking at valuation, how important valuation is to the angel investor in the context of the returns that will be generated by the angel investor with your investment. So from the entrepreneur perspective, you want to basically say, hey, I want a bunch of money, but I don't want to give up a very big percentage of the company. I want to give up as small an amount as possible. Obviously, the other side is, I want to give you some money. I'm interested in giving you money, but I need to maintain a certain return percentage, and therefore I want a bigger part of the company. And sort of that back and forth is in this book and really good. Investment rounds, this talks about once you dance with the devil, meaning the investor, what's going to happen down the road? Because that's what is effectively happening. It's not selling your soul, but there's a trade-off there. You've now gone into a marriage, and you can't get out of it. So what's going to happen in subsequent rounds? What needs to happen? What do the typical scenarios look like? That's in this book. Deal negotiations, some of the details of how you could be negotiating this, what you should be looking for. Term sheets and closing. I'm not a term sheet guy. I'm not a deal or due diligence guy generally. I let Hyde Park Angels handle that for me. But term sheets and what some of the terms mean, like preferred and participating preferred, and some of those things are in there. Portfolio management. Again, this book is written for angels to read. And so I'm giving you the tip. If you want to understand how we're being told to think and how a lot of angels do think, read this book and you'll understand the other side. And that's important to help you reach that successful conclusion. Questions on this before I move on to the next slide? Yeah.
Do you feel with books like this, which a lot of angels will read themselves, that there's a lot of group thinking when it comes to the investments, the way that you look at investments, or the same, so you overlook certain investments that could be the potential unicorn that just because you don't fit this metric weren't looked at?
So I think that, I'll tell you a story. So Hyde Park Angels has been around since 2007. In 2015, it was, David Rose came and spoke. He wrote this book and came and spoke at our annual summit. For those 8 years in between, the angel group, as well as the individual angels, didn't really think this way, didn't understand to sort of think this way, weren't professional enough to think this way. And so the smart angels, who sort of really get investing and things like that, they probably thought this way because they understand basic investing. But people like me, I'm a successful entrepreneur. I didn't know, so I was, that's a really good idea. So let's do this investment and that, and there's a sort of learning curve there. And what I'm saying is that I think that less than probably 20%, probably less than 10% of all angels in the U.S. have read this book or will read this book. So this gets to a point later that all angels are different, and that's actually the advantage of the entrepreneur, because there is an angel out there for you. The challenge is to find it. Does that answer the question?
Yeah, absolutely.
Okay. So this is I hope you can read that. Can anybody not read it? Because I have a printed version I can send around. But this is for Hyde Park Angels, the investment considerations. This is public, at least I think it is. These are the 5 things that we look for in companies. I'll send this around. I've got the paper right here, so let's just send that around. So I'm just going to go through these for a few minutes so you can understand a little bit more behind it, what it means. But expertise, so we, and let me put this in context again, Hyde Park Angels, we're an angel group. We have 100 angels in the greater Chicago area who invest in companies as a group. Not all angels are part of a group, not all groups are this big, not all groups focus on membership to assess and provide post-investment value add. So we're looking at your opportunity or your business and say, do we, as Hyde Park Angels, have the expertise within our group that we can add something to you if we invest in you? So let's say that you have, let's say you're Snapchat as an example, right? If Snapchat came to us with what we know today, but 8 years ago or whenever it was, we would look at that and say, do we have mobile experience? Do we have, let's say, business to consumer experience? Do we have media experience? If we have some of those, then that we would go, okay, check, this makes some sense for us. We have some experts in the group. Why does that matter? Because we take those experts and put them on the deal team looking at the opportunity so that we can take lead. And part of the value of Hyde Park Angels is that we have all these people that have lots of entrepreneurial expertise, so we know what some of the pitfalls are with that idea that's coming in front of us. Value, a compelling benefit that motivates recurring behavior from a large target market to adopt the company's solution. So this one is, there's a lot to actually unpack in that, and I'll take it one point at a time. A compelling benefit. I talked about this earlier, that there needs to be something that people would say, wow, this is cool, this is different, this is valuable. And I think that on the one hand, this is our perspective of what we think of your business, but I think there's a second very subtle point here, which is by asking that question, is there a compelling benefit to you, the entrepreneur? We will understand, if you really understand, what the value is of what you're doing. Because this goes back to what I talked about before with the lean canvas. So many people focus on the product, they're in the lab building something, that they forget about how do I explain this? How do I concisely and clearly tell somebody, here's the value of what I'm doing? So it's really kind of a double-edged piece there. That motivates recurring behavior. Recurring behavior is really important because then it's not you sell once and you can't sell anymore. Or you sell to somebody and then you lose that customer. It takes the most challenging thing to do is to sell somebody on your product or solution. Once you do that, you want to retain them. So if you have a high churn rate, if you sell to somebody and then they go away, that's a dangerous situation. So an investor would look at that and say, hey, that's a problem. So we look for things where there's that recurring behavior. A large target market. The reason for a large target market is, let me just see back. Did you all get a chance to see that? Large target market is important because there's going to be a lot of opportunities to fail along the way. And there will be some companies and people that you sell to that, they, for whatever reason, choose not to continue using your product. So there needs to be a big enough target that you're shooting towards, such that if you miss slightly this way or that way, you still have an opportunity to course correct and still be successful. To adopt the company solution. So that's value. Traction. Upward revenue growth or product adoption that aligns with value proposition. So upward revenue growth. This talks about, you got a great idea, that's nice, but if you don't have revenue growth, and this is just one aspect, we'll touch on another one in a second here, but if there's good revenue growth, then we can see the line and where it's headed. And usually what happens is, the reason you're asking for money at that point is because in order for that line to keep going, or the rocket to sort of make it to space and into orbit, it needs more fuel. And so you hear this a lot from investors is, we're the capital that fuels the rocket into space or into orbit. And that's because without the capital at that time, the rocket would otherwise not make it into orbit or make it into a lower orbit. And the goal is there a compelling opportunity based on seeing where the revenue is headed that by adding more money, it will continue to go or even go faster. So that's why traction is important. The other option would be or product adoption that aligns with the value proposition. So this would be the Snapchat kind of thing. There's not really a problem there, but there's a lot of usage of a product. And there doesn't have to be revenue yet, but there has to be usage. There has to be some sort of alignment of the usage with the value of what that product is. Next one is team. The team can take the company to the next stage. Teams means inclusive of management board and investors. So the risk for an investment goes up if there's one key person at the company. And that's, in a nutshell, why a team is so important. When you add, let's say, $1 million or $2 million or $10 million to that business, the team needs to be there to support spending that money. Because investors aren't giving you the money to put in the bank, they're giving you the money because there's some material event that you can do or material change that you can make in order for this business to grow. And so there needs to be a team of people that diversifies the risk that one person is the only one that can make this happen, as well as to help build and grow the company. So a team is extremely critical. I think more important than the board and investors is really the management. We as an angel group look to see what does the team look like? What is their experience? Are they a nice diverse group of skill sets? That's extremely critical. Because if you're a one-person show and you're in the lab all the time, you cannot be in the lab all the time if you take an investment. You have to be doing other things, selling, hiring. I mean, one of the things that I do 13 years in, one of the key focuses I have is to help hire people into the company. I don't do any programming. I haven't touched that stuff in years. Mark Zuckerberg, I think he hasn't programmed probably since 2008. That's my guess, right? Because he needed to move from being the product expert into the CEO. And that's a major change. So that's kind of an entrepreneurial issue that pops up. And the next round, ability to raise next round in 12 to 24 months, given market conditions and such. So, as an angel group, we don't expect that we're going to be the last ones to invest in a company. We expect we're going to be the first ones to invest. The first, let's say, we call it the institutional round, professional investors. We'll be the first ones that invest, but not the last. And what that means is, if we're investing in something, it's most likely, or our expectation, is that more money will need to be raised in the near future, 12 to 24 months. So if we can't see, by adding money and expertise to this investment, that it will grow to a point that the next round of people, the people who invest 3 to 5 or 10 million into it, will come along, then we will probably say no, we won't invest in it. That's we, Hyde Park Angels. So I'll stop and answer questions on this slide before we move on.
You said you expect to be the first round of market after. Is there a typical second round where that's
a typical second round of investors? Yeah, venture capitalists would be the typical next round. And they go from the A round or B round up to whatever, hundreds of millions. Okay, go ahead.
What are your minimum and maximum investment values, like if you have any?
Yeah. So Hyde Park Angels, we typically, because every individual angel makes their own decision, the range can be quite big. But we did investment, I think, $140,000 on the low end a few years ago. I think probably 1.5 million on the high end. But that's just Hyde Park Angels. So when we invest, if for example you said, hey, I need $2 million, and we know that we just don't have that many angels that put in that much money, we will then syndicate and say, okay, we've got friends in other angel groups, other venture capital groups that want to put money in, so we will help actually potentially put a round together, it's called, where we would say, okay, we'll lead the round and it's $2 million that we'll give. We also work the other way. We were about $500,000 in a $10 million round. because somebody else was leading around putting most of the money in. They wanted a small amount of money, but they wanted our expertise, the people that we have, to help with the investment. So we put in a small amount of money in a much bigger round. That's not our normal. That's unusual.
Thanks.
How do you decide what to invest?
How do we decide what to invest? Well, these criteria, these considerations matter, but you mean like the subject matter?
No, what number to invest in a particular company? Maybe they can ask for something, but then you can decide to give less, more, or what they're asking for. So how do you decide that?
Well, honestly, how much people ask for should be how much they need. A lot of times they don't know how much they need. They're just asking for a certain amount, or let's say more than they think they need. So we would essentially say, okay, what are you going to use the money for, right? And when you start putting that plan together, it becomes apparent, and there's a negotiation there of, do you really need this? Because at the end of the day, we're just the numbers have to make sense for us to invest in it, and they also have to make sense for you as an entrepreneur. So we would say, it might be good for you or bad for you to ask for that much money, right? So we've recommended to people, hey, you don't ask for 1.5. We think you only need 750, or vice versa. Somebody would ask for $1 million. We might tell them you actually need 1.5 because you want to get 24 months of runway. So the amount itself isn't that important, especially that initial amount. It's more important during the conversation and the due diligence to say how much is really needed. And a lot of times what will happen too, to the advantage of an entrepreneur, is that might say, hey, we want to raise 1.5 million. We get people around the table who are willing to put in 2.5 million. And so there's dynamics on how that actually can end up working out for everybody. So this gets into deal terms and valuation and things like that.
So you take a look at that set of considerations, and you see someplace where you knew on day one there was a weakness that was completely curable with money. Specifically, I'm looking at a team that you knew that you needed, let's say, 5 people. And you started out with 2, and you know there's a hole. And you'd love to go hire people to fill in those holes, but you don't have money. So now people look at the team and say, hey, we got this gaping hole here. Well, yeah. How do you get out of that pit?
Great question.
I've been fighting that one since 2012.
Yeah, I mean, that's the classic, chicken and egg problem,
Yep.
right? And I think that, I've seen situations where people say, hey, I've only got 2 people for my team. I've got these other 2 that are advisors. When we get funding, they've already agreed, and you can talk to them, Mr. Angel Investor, they've already agreed that when we get funding, they will come on board. They're already putting in 10 hours a week, let's say. They're going to go up to their 40 or 50 at that, once the funding is in. I've definitely seen that. There's definitely times that we've not invested because of the team. But I think even 2 people is not a deterrent to investing. I think 1 is a deterrent to investing.
Really quickly, since angels usually come in pre-seed or seed rounds, and at that point in time the product is it's still in its infancy and you have the traction, there's no revenue, so it's pre-revenue. How do you weight traction, or what do you look for in traction then for that company as a building?
So that's a great question, and I want to recalibrate a little bit here too to say, remember, this is the Hyde Park Angels, 100 angels in a group. So when Hyde Park Angels, let's say when I joined 4 or 5 years ago, there was a lot, we were investing a lot earlier and in smaller amounts. So we were definitely investing in, call it seed, pre-seed, I would call it no revenue opportunities. But smaller angel groups definitely do that. They definitely do invest in companies, how they look. I mean, there's one called Network, I think it's Network Ventures. And they, this guy, he's like, I will lead rounds where there's no real traction yet, or let's say early traction, because he knows he's got a certain thesis. Like, this is what I'm looking for. When I see it, I'm willing to take a lead and invest a decent amount of money in those early stages. because I sort of know the picture of what's going to happen. So this gets to the point of, again, 100 people here. There's an angel investor out there for everybody. You just have to find, there may be just one who's willing to say, hey, I like you, I think that, I want to be philanthropic. I don't care about that thing. I believe in you, and I believe in the upside potential. That's let's say that's not a structured investor, a structured angel investor, but those people are out there.
The ability to raise the next round seen as a way to spread the risk with other investors?
That would be more in the syndicate idea of the current round. The next round is all about wanting to invest in companies that can be very big, so that the returns will match.
A little dilution.
Yeah. Yeah, because we as Hyde Park Angels, we expect we're going to invest in the next round or 2 or 3. Right? We go into it knowing that's when we put the first money in, or our first money in, we know that we have to reserve some in our own portfolios for we're going to have to follow on. Is there a question?
Yeah, I think you answered my question, but again, so should the product be in the market, or should we finish it?
Yeah, so should the product be in the market or be finished? Again, it depends on who the target is. So this gets to a little bit of a different point, which is I was having a conversation earlier today about a medical product, for example, and we as Hyde Park Angels don't invest in healthcare as much as we used to, or even in comparison to other verticals. So when you're talking about whatever your product is, targeting, this gets to the investment thesis. So when you start looking for your investors, you should be looking not at just an investor. Like Illinois Venture is a good example, right? They're here, but they have a certain thesis. They have certain things that they look to invest in. It might be verticals, or it could be Illinois-based companies to help support the community. So every investor has their own thesis, so you want to really try to focus on investors that have a thesis that matches with either the product you have or some match somewhere. So you wouldn't want to go to a company that focuses in software if you're a healthcare hardware company or you're a battery company. Right? So that's a really important point. When you're looking for investors, try to find the ones that understand your business and do investment or not, that's one thing. I'll maybe put that to the side. But then more, okay, you want to take the investment, and what's the expectation of how much the person should be involved? You should want them involved somewhat, but if you can't control the investor and the amount of time that they're taking from you, then that's going to be a problem, because it's likely going to either distract you from your business, or they're going to impose a direction on your business that you actually don't necessarily maybe want it to go. And the challenge, the sort of challenge there is really that if we say this, to our companies, we're not here as the investor to run your business. Some people, so an activist investor, let's say, wants to run the business. If they want to run the business, they probably should be buying more than 50% of that business. But you will absolutely see investors, and this gets to the data part of identifying, is that investor right for you, where you should spend time. You should not be walking into a meeting and saying, hey, I'd like to get an investment. Oh, okay, great, I love your idea, here's a $1 million check. You take that check. If you do that, you're asking for trouble. You have to do the due diligence on the investor as much as they're doing it on you. Ask people you know, use LinkedIn to see who they're connected to, get that independent opinion. At the end of the day, it's, you're always taking a risk, right? You're taking a chance. You never know for sure what's going to happen, but you have to give yourself enough information, as much information as you can get to make the best decision you can make at that time. And then to help deflect them, or let's say control them, the trick I would go with there is, well, first of all, I would try to get very clear expectations up front of how much time you're going to, how much time you're gonna give them, when they should be calling you. There's good ways to say, hey, look, I'm not available during the mornings because I'm working with Germany, or in the afternoons I've got calls on, I'm doing sales. You try to nicely say, hey, back off a little bit. But then the other option would be to have a second investor that hopefully is more pro you, so that you could have that person help to keep the other investor busy. And that's actually a good point, is just giving them work. If they want to be involved, hey, here's something that I need help with. Can you look up and find a connection to this company because I want to sell to them? Or hey, we might be needing some more money. Can you look for this? Or I'm looking for a COO or a VP of sales. Can you work through your network? Give them work. This is like standard board stuff, right? So if you've got a business and you have a board, the entrepreneurs that struggle the most are the ones that don't put their board to work for them. They get put to work by the board. Yes?
You might have already addressed this, I was a little late, but I was wondering, your investments are typically in the form of straight equity or convertible loans, or?
For Hyde Park Angels?
Yeah.
We do both, mostly straight equity, but convertible notes are okay as well. Especially for earlier stage stuff where the value is hard to gauge. Yes.
So from which round of funding will companies' shares diluted, and how much shares will an investor or second round funding? Will investors need the equity of the company, and how much control will the owner of the company use in the decision making?
So the typical first round angel funding of like a Hyde Park Angels, we would invest some money and we would expect 20 to 30% of the company in return. That's sort of the typical that we would see. From a next round, like a Series A, they might invest, twice what the first round invested and expect 15% equity. And just to go back real quick, in this book, I'm sure of it that in this, where is it, investment round section, I think a lot of that is sort of what's the standard, what's the expectation for those different rounds, what percentage will you be giving up? That's why I say it's a really good, there's a couple of chapters in there that I personally learned a lot from, that I think that's a really good place to get some information.
There's one in the library, and there's a couple more copies in my office if people want to borrow.
Oh, great. Yeah, great book. Yes.
And do you ever invest on your own outside of Hyde Park in addition to Hyde Park on the same deal?
So if I'm a member of Hyde Park, no, generally.
No.
I guess the answer is no.
No.
So I used to invest on my own. I just don't have the time for it, and I realize all the effort that goes into it, and so I only invest through Hyde Park Angels. So if somebody comes to me and is interested, I'll push it to Hyde Park Angels. I don't have the time. I realize what I'm good at and what I'm not good at. Due diligence, term sheets, that stuff, I just don't have time for it. I'd rather let the experts handle it. So I would typically only invest through Hyde Park Angels then, actually. The only way that wouldn't happen is if I were maybe getting a board seat because I was the one that really liked the investment and I had an opportunity to do it separately and I really believed in it. Okay, yeah, go ahead.
Do you ever deal with like conflict of interest with Hyde Park? Like if somebody pitches a subscription billing service and they say like, oh, talk to Craig about it, it's clear to you that this company is in direct competition like with your own.
Nobody, I don't think there would be a conflict, well, I would have a conflict of interest at Cleverbridge if I were to invest and take a board seat in a competitor or something like that, absolutely. But I could get approval internally if I wanted to do that. Okay. I'd have to get approval, of course, but I could do that. Yes?
Sorry, I have a couple of questions. First is, you said like you don't have much interest in healthcare sector. Is it zero interest or above zero interest? That's my first question.
For me personally?
For Hyde Park.
No, we do invest in healthcare, yes, but we just don't do as much as we used to, and we just don't have a team. Like our expertise, we only have a few people that are really knowledgeable about healthcare.
Oh.
So like we looked at CAS 21, I think last year it was, and we went down the path with them, but our internal people said, this doesn't quite look right for whatever reason.
Because we are developing a vaccine, that's why I'm asking.
Oh, okay.
And also the other question is, if a company needs only $200 to $300 from you, like you still need 20% of the company, 20 to 30%?
$200 to $300 or $200 to $300,000?
$200,000 to $300,000.
Okay.
Sorry. I need a little bit more.
Yeah, I mean, that's probably a situation, yes, the answer is yes, because that's our model, right? That's the financial model that works for the return size. That's a scenario where you probably would be better off finding some individual angels that could offer some slightly different or better deal than a Hyde Park Angels could.
Thank you.
Okay. I think I just have a couple slides here. I'm going to give you a few lists here. So this is not comprehensive, as you can tell. There's only 6 points out here, but reasons angels don't invest. Small target market. So we already talked about that a little bit. No expertise in the target market. We talked about that. I think that that's good for you, right? As an entrepreneur, that's good for you, and it sets the message that the point is you should be looking for people that have some expertise in your area in order to find the right investors, because otherwise you will spend a lot of time educating the investor on your business, and it's ultimately probably not a good thing. Angels don't invest sometimes because of founder ego, whether that's the valuation, the term sheet, whatever it is, the founder ego gets in the way, and that can be good or bad, right? Founders who have a very strong will, I mean, it's not the best story right now, but Outcome Health, they've had some issues, but they grew a long way, and the founders there are very strong-willed, and they had the chance to take money in the early days. And they just kind of went back and forth. They finally said no, and it worked out great for them, right? At least up until recently. Investment terms, we've had situations where a founder says, no, I need to have this minimum valuation. And we've done our math, and we basically say that's just not, that doesn't seem right for where the company is today. So we've not invested. Economic conditions, right? 2009, 2008, there's all kinds of reasons. This is actually an important one from the venture capital side. Venture capitalists have funds, and when those funds have a lifespan, but they have an investing lifespan. The investing lifespan is usually 4 to 5 years. And so what that means is if you find a fund that is really interested in you, if you're towards the tail end of their investing period, they may run out of money to actually invest in you. It might not be a good thing for you because when you want the follow-on, they may not have money later. So there's kind of an interesting dynamic there where you might want to, you should look at that part. And then just personal issues with angels, I talked about this, right? Angels might have, for whatever reason, the personality, there's not a click, there's not, it just doesn't work.
You started out by saying it was a marriage, so if you don't make the love connection,
exactly, it's a marriage, right? And it could end in divorce. But in venture and in angel investing, it's a lot harder because you've got a long-term contract that you can't get out of easily. And many other reasons. So I just want to summarize in a slightly different way some of the things I talked about throughout the whole session here. Product strategy is different than the company strategy. I think this is so important back to the lean campus. Your product is great. Don't fall in love with it. Make sure you understand how it's going to be a business because that's what the angels care about. They do not care about your solution as a just solution. They care about the solution as part of a business. Angels care about different things than you do. That's the same point from number 1, but said in a different way. Number 3, not all angels are the same, like I mentioned. Just because one angel says no does not mean the next one will. Just because 9 say no doesn't mean the 10th one will. So you have to be persistent, but you help your chances and increase the percentage that you'll find the right angel by doing your homework, doing your due diligence in advance, and searching for the right ones that match, where their thesis matches what you have. Teams matter. Having a team that's worked together for a number of years is obviously way better than being somebody who just met their partner yesterday and are now asking for money. I had a meeting with somebody. It wasn't really about investing, but had this meeting one day and the next week already one of the co-founders was gone. And it's like, okay, that's a big red flag to me as an investor. It's like, what's going on? because I know I'll never get the straight, full story. Develop your idea as long as you can without investors. SBIR funding is fantastic. It's non-dilutive. We recently at Hyde Park Angels had an example. I can't give you the name of the company, but they had taken a total of, I believe, 1.3 million in funding, in actual angel funding. They also had taken and spent 4 million in non-dilutive funding. So they're way farther ahead than the typical company that comes to us, because they had all this money that came through government grants and different things that they were able to spend to build their business, such that when they came to us, I suspect the valuation will be much higher than a normal company. And the last one, enjoy it, right? The whole idea, and I did not come up with this, you probably won't be surprised when I say it, but enjoy the journey, not just the destination. The journey is the destination, right? It's that whole idea of enjoy what you're doing, because if you don't enjoy it, and it's not about enjoying the raising money part, but if you don't enjoy what you're doing in the business, then raising money is going to be painful for you. It's not going to be fun. And honestly, I question, should you be doing it? Because it's hard. I don't know from personal experience of having raised money, but I know from the other side of the table now, I don't envy people that are having to ask for money. I have not seen a lot of happy faces on the other side. Because I know it's painful. It's painful. So, not today, right? Today everybody's happy. We're just over 1 o'clock, so I want to thank everybody for their time. Great questions. This was exactly what I was hoping for, very interactive. Please follow me, connect to me. I'm happy to talk to anybody after this or afterwards over the phone or via email in the future. So thank you all very much.